Hello everyone, thanks for checking out my video. Quick announcement, there will be no video next week, but I will be back the week after. Alright, let's now talk about the market. Investors struck off a US government shutdown last week as all three major indexes hit new record highs again, with the S&P 500 clinching a 6-day winning streak. Wall Street seems to be more focused on the AI boom than political drama, with stocks powering higher despite shaky jobs data and even a delayed jobs report. This bullish momentum doesn't look like it's slowing down just yet. So with all the major indexes smashing all-time highs like business as usual despite the US government shutdown, here's the million-dollar question. Is there enough gas in the tank to sustain the bullish momentum? And if the shutdown persists on, will it then impact the stock market? Well, let's break it all down in this video. As always, stick around until the very end for extra insights. Okay, as mentioned, the Wall Street has largely struck off the US government shutdown last week. This is probably because investors expect it to be short-lived, therefore limiting potential hits to the US economy. Many investors also believe that the shutdown won't stop the momentum in the AI industry, and more importantly, the US government shutdown have not been market-moving events in the past. Okay, but that being said, the latest shutdown has led to an economic data blackout, which delayed the release of the monthly jobs report last Friday. Although some might think that this has removed a factor that could potentially add pressure to the stock market, it lessens the amount of economic data the Federal Reserve can take into account for its interest rate decision at its October meeting. Anyway, without the big monthly jobs report, investors have turned to alternative data from public and private sources, and so far they are pointing to a sluggish US labor market. One of that is the survey by the Institute for Supply Management, which showed the Services Employment Index contracted for the fourth consecutive month. The news emphasized the case for more interest rate cuts from the Federal Reserve. For the new week ahead, the US government shutdown will continue to be the top of investors' mind as the stock market hits into a seasonal strong fourth quarter, with an average gain of about 2.9% and a high probability of a positive return. So this bullish seasonal trend will definitely be tested by the shutdown and the new earnings season. In the meantime, the market is also expecting a delay in the release of other economic data as well, such as the weekly jobless claims and potentially the CPI and retail sales reports. This means both the Federal Reserve and investors will face increased uncertainty in decision making, potentially leading to heightened market volatility as they await clearer signals on the US economy's health. Speaking of the Fed, they will be hosting a community banking focus conference in Washington on Thursday 9 October. The conference will discuss key issues facing the community bank sector. There will be a welcoming remarks by Federal Chair Jerome Powell, but his speech is pre-recorded. Let's see if he has any surprise for the stock market. Let's move over to the technical analysis portion. The broader market, as represented by SPY, is simply looking bullish. As you can see, every single dip has been bought up by buyers since April's tariff sell-off. SPY has embarked on this very nice uptrend for a few months now, as shown by the green trend line. At the current level, like I have repeated multiple times, it's called uncharted territory, which means expect record highs almost every week or every other week. We have been seeing it for a few months already. This trend will only stop when something serious and unexpected happens in the macro environment, which is impossible to predict. But if it comes, whether is it this month, next 3 months or even next year, I would say watch that green uptrend line closely. If SPY goes below it, that's your first signal that the bears might be back. For confirmation of bearish trend, watch out for 645 and 646 levels, because this is where the pivotal 50% Fibonacci level and the 50 moving average are. So long as we are above this area, everything's still looking good. Next up, let's check out Apple's chart. Wow, Apple hit a new record high last Friday. The momentum looks strong to me, and I wouldn't want to short the stock at the moment. For the upcoming week, don't be surprised to see more record highs as FOMO investors might step into the stock. Who knows, we might see 260. Once again, at such uncharted territory, you really don't know when a meaningful pullback will come. So for me, I will just enjoy the upside while not FOMO by chasing the highs. On the other hand, if somehow we have a retracement and don't get a new record high this coming week, Apple does have plenty of buffer and room to fall. The first target of the bears would be none other than the gap area between 246 and 248. If Apple bounces up after filling this gap, that's pretty bullish in my opinion, and that could bring Apple to test the record high again. However, if it continues to fall below 246, I would say pay attention to that blue support line at around 241. Honestly, like I shared in my last video, I don't expect Apple to drop below 241 in the next 1 or 2 weeks. Well, some might see this as a good level to sell put option. That said, nothing is guaranteed, okay? Let's say this 241 level breaks, then I think it will unlock more downside towards the 230s and even 220s range. This is the area where Apple used to consolidate before it had a breakout to the upside. Moving on, let's have a look at Tesla. Wow, that's two nasty red candlesticks. The one that appeared on last Thursday is called a bearish engulfing candle, and the Friday's price movement basically validated the bearish candlestick. In short, Tesla is looking a little bearish now, especially the MACD just had a bearish crossover as well. Alright, for the upcoming week, watch the first Fibonacci level at around 424. If that level breaks, I think it will unlock more downside. Probably a good 20-point drop towards the 400 level. At 400 level, don't be surprised if the bears will fill the gap, which is between 396 and 402. At this area, the bulls have to step in already, because if they don't, there is actually not much support below. That means we could be back to the low 370s range to test the pivotal 50% Fibonacci level. From the bottom of the gap, which is 396, to the 50% Fibonacci level at 372, that's a good 24 points drop. In short, watch the key support levels closely this week. When they are broken, I think the odds of a quick flush down would be high. On the other hand, if somehow last Thursday and Friday were merely a buy the rumor, sell the news kind of pattern in relation to Tesla's delivery numbers, then the bulls might step in and invalidate my bearish thesis. For that to happen, just a quick one again, if you appreciate my effort and my free content, you may consider supporting this channel through any of the following ways. I would be very grateful. Feel free to pause the video to go through the details. Okay, for the bullish thesis to play out, Tesla needs to reclaim that blue resistance line at around 438. If we can put about 2 green candles above it, then before you knew it, we could see Tesla in the 450s and 460s range again. And the longer we can stay above this blue resistance line, the higher chance Tesla could break the recent high of 470 and push towards 480. I know the record high sits at around 488. My personal take is that it is quite unlikely for the price to go near this record high level before Tesla reports its earnings. Let's now jump over to Google. Google is going through a small and healthy retracement. To be honest, there's nothing much to analyze. The analysis is pretty straightforward. If the retracement continues this week, just watch the first Fibonacci level at 228 and the purple uptrend channel. So long as Google doesn't fall below both of them, this pullback is still very healthy and nothing to be concerned about. In fact, if we can bounce off either of the support levels, it is bullish, as the indicators would have been cooled off already. The next leg up, if it happens, I'm expecting a new all-time high. Okay, but on the other hand, if Google drops into the downtrend channel, then I would say it's almost certain that the big gap would be filled by half at least. This gap is between 211 and 224. Within the gap, I want to highlight that there is a 50 moving average that sits at around 221. Google has not closed below this level since May this year. Therefore, if we ever get into the gap and Google doesn't bounce off the gap or the 50 moving average, then I would say the trend has officially turned bearish. That's when we could possibly see Google back to the low 200s range. That said, again, given how strong the current market is, I think it's quite unlikely for this to happen before it reports its earnings. Next, let's check out Meta. Among the stocks that I covered, Meta is actually the most bearish one. I mean, you probably can tell with the 11 red candles out of the last 13 trading days. Not just that, the share price fell back into the downtrend channel and we had a bearish engulfing candle last Friday. So many bearish signals. And guess what? I actually stepped in to sell a put option, which is a bullish move. More on that in the options trading segment. But this move shouldn't come as a surprise because I shared in my last video that I will consider taking some form of action if Meta falls to 708 to 721 area. Anyway, what's next? Okay, for Meta to stop its short-term rot, it has to obviously get out of the purple downtrend channel again. By doing so, it also means that Meta would have reclaimed the 38.2 Fibonacci level at around 729. Okay, but that's not enough in my opinion. Personally, I would want to see Meta reclaim the 50 moving average at around 752. Then I would say Meta has reversed its short-term bearish trend. Because other than being an important moving average, by closing above 752, it will likely mean that Meta would possibly also reclaim the 23.6 Fibonacci level at around 754. Alright, as for the bearish thesis, watch the 708 level closely. This is the pivotal 50% Fibonacci level. If it breaks, I think the probability of Meta falling below the huge 700 level is pretty high. In my view, the last line of defense is actually the 61.8 Fibonacci level at around 687. If Meta loses it, then I think all hell could break loose. Moving over to Microsoft. Microsoft looks neutral and maybe leaning bullish a little. Let me explain. First up, like I shared in my past few videos, Microsoft has been trading sideways and hugging the 50 moving average since late August, so that's neutral, and some call it consolidation. In simple terms, it means no clear direction. But why I said it's a little bullish is because the share price has closed above the 50 moving average for 4 consecutive days. Not just that, price action wise is trending upwards with higher highs and higher lows. Okay, but I must caution, the bullish signal is not very clear yet. It is only slightly bullish. That said, personally, I wouldn't take on any bearish positions right now simply because it's leaning bullish, and who knows, it might break out anytime. For confirmation of a breakout, watch the 23.6 Fibonacci level at around 523. If we can put a few candles above it, just like how it did so above the 50 moving average, then I will say Microsoft is pretty bullish. A solid footing above 523 will likely push the share price towards the high 530s range. On the other hand, if the market makers decide to reverse the mini bullish trend, then we got to be prepared to shift our sentiment too. For bearish confirmation, simple, watch that 50 moving average again. That's your best indication in the short term. If Microsoft drops and closes below it for a few days, then things are leaning bearish already. Below the 50 moving average, I will watch the 38.2 Fibonacci level at 504 as well as the recent low of 492. The bulls need to protect these two levels. If Microsoft moves below both of them, a lot more downside could be unlocked. Last of all, let's check out Nvidia. If you could recall, my last video mentioned that we could see all-time high. I also shared that if Nvidia can push above 184, it's rocket time. And Nvidia did it. It went above 190, a new milestone. I'm glad that I sold a few put options recently. Alright, so what's next? I know we had a small pullback last Friday. To me, it's nothing too alarming. If the share price can bounce off that resistance turn support level at 184, I'm actually expecting Nvidia to charge towards 190 again and possibly create another new all-time high in this uncharted territory. Okay, but if let's say the pullback wants to last a bit longer and deeper, then we might lose that 184 level. Below 184, I will skip that 23.6 Fibonacci level at around 181. Reason being, given how volatile Nvidia can be, losing 184 will almost certainly lose 181, at least in my opinion. Therefore, below 184, I personally will watch out for the 50 moving average instead, which sits at around 178. Don't be surprised if the share price falls below this moving average too. It's nothing too concerning because it has done it on a few occasions. The key thing is Nvidia needs to bounce back up within a week. Just one more thing to add for the downside. If Nvidia goes below the 50 moving average, pay attention to 173. That's the recent low created in September. If Nvidia goes below it, then it would have broken this series of higher lows, which means the price action has turned bearish a little. Sorry, before I end this segment, a few videos ago I think I brought up this potential bullish inverse head and shoulder pattern. It seems like it's playing out. If it does, then by right, Nvidia still has room to go up to the 190s range. Okay, I need to caveat, nothing is guaranteed, okay? Alright, let's now check out my options trades. I have 3 trades to update this week, and they are summarized on the screen. The first trade is this new cash secure put on Meta that was sold last Friday, 3rd October. The strike price is $5.75 and the contract will expire on 7 November. The reason for selling this put option is pretty simple. Okay, as mentioned earlier, 11-week candles out of the last 13 trading days and the share price fell back into the downtrend channel. Everything looks bearish, right? So why do I still open a bullish position? Well, my view is that Meta has fallen about 10% from its recent high of 790. That's what people define as a correction. Sure, it can fall further from here, but I am anticipating a small bounce or sideways movement soon. That being said, I must also admit that this is a risky trade, given how bearish the price movement is right now. Furthermore, when I sold the put option last Friday, I wouldn't have been able to conclude if we will have a bearish engulfing candle when the market closes. And it did. So, knowing that it is a slightly riskier trade, to manage my risk, I chose a strike price that is far below the current price. Below the current price, I have multiple Fibonacci support levels and the 200 moving average acting as a strong support. So all in all, after falling by 10%, Meta has to crash another 20% for my strike price to gap bridge. Not saying it can't happen, but I think the odds are not that high. Okay, moving on, I will combine the next 2 expired contracts together. One is a cash secure put on Tesla with a strike price of $265, and the other is also a cash secure put but on Nvidia with a strike price of $155. Both contracts were sold on 29 August when Tesla was trading at 330s range while Nvidia was in the 170s range. As of last Friday, Tesla closed at around 430, which is 100 points higher than my strike price, while Nvidia closed at 187, well above my strike price too. As a result, both contracts expired worthless and the total profit for these 2 trades is about $380 which is close to 500 Singapore dollars. Not too bad, right? Okay, final segment of the video, my thoughts. Well, the stock market has moved higher in recent weeks due to 3 main reasons: relatively strong corporate earnings, enthusiasm about artificial intelligence, and hopes for Federal Reserve rate cuts. But here comes a potential roadblock, the US government shutdown, which some thought that it might dampen the mood and market rally. However, it seems like investors weren't quite bothered by it. One of the reasons could be because history has shown that the stocks are usually unaffected by shutdowns, as these shutdowns have been more headline events than bottom line affecting events. That being said, if the shutdown drags on, it could be a different story, because the lack of government data could strain the Federal Reserve and investors' understanding of the health of the labour market and path of inflation at a time when stocks are historically expensive and vulnerable to a surprise. I mean, there is no good time for a shutdown per se, but this one might have come at a wrong time. Should the data drop last several weeks, it could cause confusion about the Fed's monetary policy path, as the central bank will be without government data that helps guide its decisions. In addition, it also poses a possible drag on economic growth the longer it extends. All this will create an uptick in uncertainty, and we all know the market doesn't like uncertainties. Therefore, in essence, the length of the shutdown is key. Okay, just my personal view, I think even if we have a pullback that is directly caused by the shutdown, it is a short-term thing, because the government has to reopen eventually, and the economic data and reports will catch up on its schedule, and it will then be business as usual. My point is, the shutdown is going to be the news in the near term because it's newsworthy and eye-catching. That's how the media industry works. But I think we should ignore these media noises, just like we always should, and pay attention to the underlying backdrop from now till year end, which revolve around 3 things. First is the seasonality, which is turning positive. Second, it's the tailwind of rate cuts to protect the labour market, and finally, it's the corporate earnings. I think it's pretty important to stay focused on what really matters, and that would be resilient fundamentals and an economy that is still holding up. Keep a close eye on policy shifts, labor market trends, and the evolving AI landscape. These are the key drivers for what comes next in 2026. Meanwhile, in the short term, without all the economic data, yes, investors are flying blind, but I think they don't seem to mind. Alright, that's all I have for this video. If you have found my content useful, do help to tap the like button and comment something below to boost the YouTube algorithm. Thank you.